We'll begin first with our economist. If you'd like to give us a bit of your outlook. Now, Mr. Six, or Dr. Six did say to me that it looks, having just come to MIPIM, people seem quite buoyant and happy and things are happening, but he might want to dampen our mood a little bit. Let's see.
Well, thank you, Courtney, and good afternoon, everyone. Yeah, I'm not sure I should speak actually this afternoon. It's been quite an experience today, walking around the exhibition halls and talking to people and listening to various conversations. I haven't been to a conference probably in the last 2 years with such a vibrant atmosphere. It's good to see that there are still places where business is being done and people seem reasonably optimistic in the long term. So take what I'm going to say now with a little bit of hindsight. I'm going to talk more about what economists call the real economy, GDP, consumption, and things like that. And I'm afraid that the message today is still not very uplifting. Europe's Europe's economy fell back in recession in the fourth quarter of last year, with GDP and manufacturing contracting in the majority of our economies. High-frequency indicators that we've been receiving since the beginning of the year confirm that, indeed, we are in a new phase of contraction, or at best, flat growth, thinking about Germany, for instance, or more severe contractions in the south, obviously. And so I think the question we are presented with is the following. Is this the second leg of the severe depression that started in September 2008 after Lehman Brothers and took our economies down, as you obviously remember, in 2009? Or is it likely to be a more technical, a milder recession that could end at the end of 2012, followed by a gradual recovery in Europe? In 2009, emerging markets really became the locomotive of the world economy, experiencing a very sharp bounce back, a very sharp recovery early on, from the middle of 2009, and really helped our developed economies get out of the trough. In 2010 and early 2011, central banks in those economies had to tighten their stance because inflation was accelerating on the back of higher commodity prices, as you remember. And obviously, as this tightening was simultaneous across all emerging markets, let's take the 26 largest emerging markets at the moment, they all almost simultaneously clamped down on money supply, raised interest rates, and that obviously caused a significant slowdown in their economies. So that's the first factor, emerging markets. That's probably the most encouraging factor that we have in front of us, leaning towards a mild recession in our economies. The second factor is consumers, us, European consumers, and how are consumers going to arbitrage between consumption and savings as the fiscal environment becomes obviously extremely tight. The third factor, probably the most important, especially for you all, is how can we secure a return of confidence from international investors in European capital markets. As you know, there was a significant breakdown in confidence starting in the second quarter of last year, when we started to see Italian bond yields, sovereign yields, starting to go up very markedly through the summer, when really international investors, especially non-European investors, started to really question the fundamental belief that they've had so far in the Eurozone and its ability to govern itself. At the moment, we estimate, and this is subjective obviously, but we estimate that there is a 60% chance that at the European level, we may escape a second leg, a double dip, a true double dip, and instead experience a mild, we are in recession at the moment, so that's not the question, but a mild recession that could be followed by a mild pickup, a gradual pickup into 2013, and a 40% chance that we fall back in a more severe depression with all the possible consequences that I leave you to imagine.
Real estate economy is related to the normal economy, so there is no place for a brighter picture. And the uncertainty you described is definitely true for an uncertainty also in the real estate markets in Europe. There might be two ways Europe goes within the next few months or years. So I divided that into a consensus model and a worst case model. And the consensus model is that we come through, like Jean-Michel last said, the crisis and the recession as a slight recession. And despite that, we will see a risk of market weakness in this year and definitely also next year. But we see no downturn, real downturn, also in the real estate markets. We see a decrease of demand for space and take-up. That's for sure for all markets in Europe, especially compared to 2011, where it was a slightly bright world there. We see stable rents in the prime segment because we have no new completions, no developments under construction, so there is a shortage of modern quality space. And prime properties, like last year, are still in the focus of investors. What is definitely true is that investors are accepting very high prices for these properties. Last point is that investors are looking for those countries who are seen as stable countries, like Germany or the Scandinavian countries, so that there is a division between two parts of Europe in the last few months or even 1.5 years. That's the point for how are investors reacting on that, which is a very simple reaction, flight into quality and security. Yeah. Is real estate still attractive? I would say yes, because we see investors buying still real estate, and there are less alternatives to invest. So the relative attractiveness of real estate to other asset classes is impressive. If you compare real estate versus bonds or government bonds, you see a very positive yield gap to these bonds, and that, together with the relative low volatility of the income streams of real estate, is attractive for long-term investors like insurance companies, pension funds, and so on.
Is there any possibility of investors maybe just looking at other regions? I mean, maybe focusing more on Asia, for example, and maybe putting Europe on hold a bit until the dust settles? Or will they, as you say, just kind of focus on the safer areas?
I think what we can see is that investors in the crisis times are focusing on their home markets. That is what they are doing. And what we can see in the last 1 or 2 years is that many of the institutional investors are buying direct investment instead of indirect investment, and they're doing that in their home markets. French are buying in France, and Germans are buying in Germany. And that is a trend what we have seen over the last 1 and 2 years. And not so much a flight into North America or Asia properties. That might be a part of that, but not a very, very strong part. What we definitely can see is that what Jean-Michel describes, this division of Europe, of those countries which are stable, which have good prospects, like Germany, like the Scandinavian countries, like Poland, for example. But if I would try to convince one of my investors to go with me to Hungary, for example, even if you say you should invest anti-cyclical, yes, and you can go into this market now at the bottom of the market, that would be impossible to convince my investors. Looking at the real estate market in UK, and I will focus on London because it's the main market there, what we can see is that rents and yields have recovered already and are very far advanced already after the crisis. And even if that's so, there is a lot of money flowing into the London real estate market. And the reason for that is that if you are looking from outside on Europe, there are two very big real estate markets, which is London and Paris. Yeah. And if you invest and doing perhaps your first investments in Europe, you will focus on those two big cities. That's the first point. The second point is both of those markets, and especially London, are very liquid. So if you want to go out of that market, you will definitely find a buyer. Yeah. And that is very important for those investors coming outside of Europe. And if they want to withdraw, they are able to withdraw. If you are investing in Hanover or in Barcelona or wherever, you will have problems in some times of crisis. So that's definitely one of the main reasons they are investing there.
There is still this belief when you go to Singapore or Beijing or Korea, that Europe is along with America, say, the wealthiest area in the world, with a lot of purchasing power, with democratic institutions, etc. And so there is a desire, in a way, to see this area coming back and get its act together so that we can work with them again. So that's why I was saying in my opening remarks that this is really a moment of choices for Europe, where either you improve institutionally and practically your governance and the way you operate as a family, to be quick, or you go back and you say, well, no, which I don't think is an option, but anyway. But it's decision times.